A mortgage loan involves two transactions wrapped up or merged into one agreement or contract. In the first transaction, a financial institution, be it a bank, credit union, insurance company, or other money lending institution, lends you a lump sum of money referred to as the principal. In exchange, you promise to repay the principal with interest over an agreed period or at an agreed time. In the second transaction, you transfer the title to your property to the financial institution while retaining possession and promising to keep the property insured and properly maintained. In exchange, the financial institution promises that it will hold your property as security and only sell it if you fail to keep your promise to repay the loan. So a mortgage loan involves a bank lending you money. For example, $100,000 repayable over 10 years at 5% interest per year. In exchange, you give the bank a mortgage by handing over the title to your property for the bank to hold as security. A mortgage loan can be used to acquire property. In this scenario, a financial institution lends you the money to buy a property. The sum of money loaned is referred to as the principal. In exchange, you promise to repay the principal with interest over an agreed period or at an agreed time. At the same time, while retaining possession of the property that you just bought with money from the financial institution, you transfer your title to the financial institution in exchange for the promise from the financial institution that it will hold it as security and only sell your property if you fail to keep your promise to repay the loan. This kind of mortgage is referred to as an acquisition mortgage, or where it is used to purchase a home, it may be referred to as a home mortgage. A mortgage loan can also be used to raise a sum of money for a purpose other than acquiring a property. In this scenario, you already own a property and you want to raise a sum of money to start a business or send a child off to university. The financial institution agrees to lend you the money. The sum of money loaned is referred to as the principal. In exchange, you promise to repay the principal with interest over an agreed period or at an agreed time. You then transfer the title to your property to the financial institution while retaining possession in exchange for the promise from the financial institution that it would hold your property as security and only sell it if you fail to keep your promise to repay the loan. A mortgage can also be classified by the manner in which it is repaid. It may be a repayment mortgage or an endowment mortgage, or it may be a combination of the two. In a pure repayment mortgage, you pay off the loan by making equal payments each month over the life of the loan. Each repayment is made up of part interest and part principal. In a pure endowment mortgage loan, you pay the principal in one lump sum at the end of the period of the loan. Before that, you pay interest only. If you have a mortgage loan and you fail to keep your promise to repay the loan, the financial institution can sell the property it holds as security to recover its money. In selling your property, the financial institution must act in good faith and seek to obtain the best price that can be obtained in the market at the time the property is sold. The financial institution cannot simply decide to sell the property to recover what you owe. It must make reasonable efforts to obtain a fair market price. That is the best or substantially the best price the property can attract in the market at the time it is sold. That would mean that the financial institution must have a recent valuation of the property, and it must properly advertise the property. If the financial institution fails to take reasonable steps to obtain a fair market price for your property and ends up selling it at an undervalue, you can sue the financial institution for the shortfall in the price. If your property is sold by the financial institution, after all the reasonable expenses associated with the sale, such as legal costs, estate agency costs, outstanding property tax, and outstanding loan amount are paid off, the excess must be handed over to you. However, if the property is sold and there is not sufficient money to pay off the loan, the financial institution may seek to recover the excess from you, the borrower, and may even sue for it. If you have a mortgage loan which requires you to make monthly payments, and you default by failing to make monthly payments for an extended period, you may fall into a debt trap. You may fall under mounting debt. Debt that is growing rather than reducing. And it may be extremely difficult to get out of the trap. When you make a monthly payment on your mortgage loan, part of the payment goes towards paying interest generated in the month, and the other part goes towards reducing the principal. The debt trap stems from three factors. Firstly, when you stop making payments, the interest continues to run on the loan, with the effect that the loan is growing rather than reducing. Secondly, if and when you resume payments, the money you pay is first applied to interest, and only after all outstanding interest is paid off is any money applied to the principal. Thirdly, while you are making payments to pay off outstanding interest, more interest is being added monthly. In extreme cases where the amount being paid when you resume making payments is less than the amount of interest being generated monthly, it can and has happened. Even while paid, the debt is growing. Ultimately, the only way the debt can be paid off is by the financial institution selling your property. And even then, there could be a shortfall, which the financial institution can then sue you to recover.